Let's bring in Seema Shah, Chief Strategist, Principal Global Investors. Nice to see you, Seema. Your reaction to the news from the Fed.
Thanks for having me on. Yeah, it's exactly what was expected. We needed the Fed to make a move, make an aggressive move, and I think they've delivered here. But keep in mind that the inflation risk since the last meeting 7 weeks ago, it's only increased. You've got inflation expectations moving higher. You've got inflation at 8.5%, wage growth up. So it's clear that this isn't going to be enough. And I think all eyes now during the press conference is going to be any kind of guidance that Powell is able to provide about what to expect over the coming meetings. Are we going to see another 50 basis point move? Is it going to be even 75 basis points? So that's going to be the key point going forward.
And Seema, you mentioned wages. Obviously, you have workers seeing higher wages to then try and pay for some of these higher prices. Then you have companies trying to then pay them more, which is then perhaps seeing some of these costs get passed back onto the consumers. How do we get out of this cycle? What is your outlook in terms of what we see with wages and prices?
Right, and the wage price spiral, that has to be the Fed's greatest fear, because once that takes off, it's very, very difficult to contain. I don't think we're there yet, and I think we have got some hopeful signs in the future that this shouldn't become even greater problem. And the reason is that although we've seen excess savings rise for most workers, for most households, actually for the lower wage households, their excess savings have really been cut down by time and inflation over the last 2 years. So actually, they are now under pressure to return to work. So we are expecting labour participation to increase over the coming months. And that should mean that the wage pressure should be a little bit more subdued over the coming weeks. But that is the key point going forward.
Seema, you mentioned just a few moments ago that what the Fed is doing today, the raising rates by 50 basis points, that's not going to be enough. They might have to hike further here, make bigger hikes, I guess, up to 75 basis points. What else do you think the Fed needs to do in order to get the economy back on track?
It's going to be very difficult. So the 50 basis point move today, potentially another 2 or 3 of that size going forward. And then, of course, rate hikes at every single meeting for the next couple of months going into next year as well. Is that going to be enough? They've got a very, very difficult job ahead of them. And from my perspective, the only remedy to such high inflation is unfortunately going to be recession.
If the Fed chair indicates a looming 75-point hike, how would the markets react?
The market is not going to react well to that. The equity market, I think, would be very concerned about the fact that Powell is moving in that direction. But then at the same time, the better thing is for the Fed to try and over-deliver now so that we don't get the risk of inflation really persisting and then having to slam on the brakes and push rates even higher. But certainly the near-term market reaction would clearly be a negative one.
And obviously, we've seen Powell and the Fed really focusing on what we're seeing with employment and really getting inflation down with less of an eye on the equity market. So what then actually poses a bigger risk then, being too aggressive or not aggressive enough?
Well, I think we're talking about the long game here. If they're not aggressive enough, then they run the risk of permitting inflation to keep festering. We'd be looking at, at the moment, we're expecting inflation to come down to only around 5% by the end of this year. And that's keeping in mind that we are expecting back-to-back hikes through this year. If they don't deliver, then you expect inflation to actually settle at a considerably higher level than 5%. And at that point, then come 2023, then you're looking at even more aggressive tightening. So actually, it's better for the Fed to get on with it now, to slam on the brakes today, that they don't need to do even more next year.
Seema, when you take a look at the market reaction today, we haven't really been seeing big swings. The Dow, S&P, both holding on to gains, I guess slightly lower than where we were at the start of the hour. When we started up at the top at 2 o'clock, we had the S&P and Dow both up just around 0.5%. The NASDAQ, though, is now negative. The big question is how much of this has already been priced in? Did nothing here today surprise the market?
No, I think this was absolutely priced in. It was a 100% chance from the market perspective that there would be a 50 basis point hike. A 75 basis point move would have shocked, and a 25 basis point definitely would have shocked. So I don't think there's anything here. It's really about watching the press conference, and I think that's where you could see some equity market reaction depending on what Powell's comments are.
All right, Seema Shah, always great to have you. Chief Strategist with Principal Global Investors. Thanks so much for taking the time.